Carrefour SA, CARRPA, is currently engaged in the high-stakes execution of its Carrefour 2026 strategy, a comprehensive transformation plan designed to pivot the traditional retail giant into a digitally focused, data-centric competitor capable of defending market share against hard discounters. This transformation centers on two critical pillars: achieving an ambitious €10 billion e-commerce gross merchandise value (GMV) and elevating private label penetration to 40% of food sales by 2026. The group's 2024 financial performance demonstrated operational resilience, characterized by strong like-for-like sales growth of 9.9% and the effective delivery of €1.24 billion in cost savings. 3. However, the analysis of profitability reveals that these substantial cost efficiencies were immediately redirected toward funding investments necessary to enhance competitiveness and support market share gains, rather than flowing directly to the bottom line. This crucial operational pivot explains the continued, albeit slight, compression in the EBIT margin, which reached a 5-year low of 2.5% in 2024, down from 3.1% in 2021. The viability of the long-term investment case, therefore, rests on management's ability to ensure that these structural savings and efficiency gains eventually stabilize and then structurally outpace the required competitive pricing investments post-2026, leading to margin expansion. Carrefour's solid net free cash flow generation, reaching €1,457 million in 2024, provides the necessary financial flexibility to fund the intensive €3 billion digital capital expenditure (CapEx) program and supports an increased commitment to shareholder returns, evidenced by a 6% hike in the ordinary dividend. The company currently trades at an LTM enterprise value to EBITDA (EV/EBITDA) multiple of 7.3x. This valuation represents a discount of approximately 13 to 18% when compared to major European peers like Tesco (8.4x) and Ahold Delhaize (8.9x). This relative discount is a clear indicator that the market is pricing in significant execution risk related to achieving the stringent 2026 operational and financial targets. Investment recommendation: a neutral/hold position is currently warranted. While management has demonstrated effective operational control in core markets, e.g., margin stabilization in France and strong cash generation, the realization of significant shareholder value uplift depends entirely on the successful deployment of the high CapEx digital plan and the structural margin recovery promised by the private label strategy. Key risks include failure to execute the €3 billion digital investment plan, sustained erosion of gross margins due to competitive pricing parity, and the financial pressure posed by high leverage metrics given the elevated annual capital expenditure commitment of €2.0 billion. I. Group overview and market positioning. A. Global footprint and core market focus. Carrefour Group SA is a French multinational corporation headquartered in Massy, France, recognized globally as the 7th largest retailer by revenue. The group's extensive network encompassed 14,000 stores across 40 countries as of 2024. Operationally, Carrefour maintains a dual focus on its established European base and the high growth potential of Latin America. The structure of the retail network is diversified, comprising 1,100 hypermarkets, 3,574 supermarkets, and 8,642 convenience stores. Recent performance data confirms the strategic imperative to shift investment away from the legacy large-format stores. In Q4 2024 in France, like-for-like sales growth demonstrated a marked contrast. Hypermarkets experienced a decline of 3.8%, while the convenience and other formats saw growth of 1.4%, highlighting the ongoing structural shift in consumer preference towards smaller, faster, and more accessible retail outlets. B. Competitive dynamics and market share defense. Carrefour operates in an intensely competitive grocery sector, particularly in its core European markets, such as France and Spain, where highly efficient discount retailers like Lidl and Aldi maintain a strong competitive stronghold. These discount models consistently pressure Carrefour's pricing strategy, forcing the multinational to defend its volumes by sacrificing price power. A critical success factor in 2024 was the group's ability to use strategic mergers and acquisitions (M&A) to bolster its position. The finalization and subsequent brand change of the Cora and Match banners in France, completed in mid-2024-12, delivered an immediate and tangible market benefit. This M&A-driven scale allowed Carrefour France to report its best market share dynamics in over 10 years. While this gain provides crucial operational leverage, the long-term challenge is centered on retaining these newly acquired customers through superior value proposition and seamless digital integration, thereby transforming a one-time gain into sustainable market dominance. Geographically, strong market share dynamics were reported across France, Spain, and Brazil in 2024. Latin America remains a significant profit engine for the group, with recurring operating income (ROI) increasing by 26% when currency effects are excluded. This regional resilience is largely attributable to the success of the wholesale cash and carry format Atacadão in Brazil. However, analysts must carefully normalize these headline figures for macroeconomic distortions. For instance, the high 2023 sales growth reported in Argentina, plus 151.9% LFL, was due to hyperinflation. Conversely, management noted a negative impact of approximately €180 million on net income in 2024 due to the strong slowdown of inflation in Argentina. This demonstrates that stable core earnings quality must primarily be derived from the efficiency and strategic successes within the group's European operations, where the French ROI margin showed a modest but vital increase of 5 basis points in 2024. 3. Analysis of the Carrefour 2026 Strategic Plan. The strategic plan represents a deep commitment to digital transformation and operational efficiency, aiming to fundamentally reshape the value creation model of the group. A. Digital retail transformation and investment commitment. The strategy is predicated on transforming the group from a traditional retailer with e-commerce capabilities into a digital retail company, utilizing a core data-centric, digital-first philosophy. To support this vision, Carrefour has accelerated its investment objective, committing to a dedicated €3 billion digital plan between 2022 and 2026. Consequently, the total annual investment objective has been raised to €2.0 billion, increasing from the previously communicated range of €1.5 billion to €1.7 billion. The cornerstone of the digital push is the ambitious objective to triple e-commerce gross merchandise value (GMV) to €10 billion by 2026. The 2024 performance, where e-commerce GMV grew 18% to €5.9 billion, indicates that significant growth remains necessary to meet the 2026 target. Financially, these digital activities are projected to contribute an additional €600 million to recurring operating income (ROI) in 2026 compared to 2021 levels. A key component of this ROI uplift is the retail media platform Carrefour Links, which is expected to generate an incremental $200 million of ROI, leveraging partnerships with tech leaders like Criteo, Google, and LiveRamp. The digital strategy is complex and involves aggressive market positioning, focusing on leadership in higher growth formats, including express delivery, less than 3 hours, and quick commerce, less than 15 minutes. While these services aim to accelerate customer conversion and improve the shopping experience, e.g., personalized recommendations and loyalty program integration, 16, the shift to quick commerce necessitates a high level of capital intensity to build out dense, optimized logistics networks. This requirement for infrastructure development explains why the high annual capex of €2.0 billion is required, placing immediate upward pressure on leverage ratios and underscoring the necessity of reliable net free cash flow growth to maintain balance sheet stability. 2. Private label strategy, the margin shield. A second critical element of the 2026 plan is the elevation of Carrefour's private label portfolio. Management intends for private label products to represent 40% of food sales by 2026, a substantial increase from the 33% recorded in 2022.
This strategy serves as the group's main structural defense against competitive price wars. By increasing the mix of private label products, which includes affordable ranges like Simple, the company is shifting its sales toward items where it controls both sourcing and margin, positioning them competitively against discounters. This mix shift is expected to provide the necessary internal gross margin leverage to offset the erosion caused by defending prices on national brands.
Operational efficiency and sourcing scale. The group successfully delivered €1,240 million in cost savings in 2024, remaining on track with its cost management targets. Future sourcing optimization is further secured by the expansion of the European buying alliance, Concordis, through the integration of the German group RTG International, effective for 2026 negotiations. This increased scale in negotiations is paramount for maintaining competitive pricing while preserving profit margins. Financial performance and profitability analysis. A. Revenue and sales growth analysis. Carrefour reported strong underlying momentum in 2024, with group sales rising 9.9% on a like-for-like LFL basis, including 7.1% LFL growth in Q4. However, this growth masks format-specific weaknesses within the core French market, where Q4 2024 LFL sales for hypermarkets declined 3.8% and supermarkets fell 1.6%. This reinforces the urgency of the strategic transformation away from reliance on legacy large-format stores. B. Detailed margin trend 2020 to 2024. Despite strong LFL sales and substantial cost savings, profitability has faced structural pressure. The group's EBIT margin has demonstrated a consistent downward trend since its peak in 2021, 3.1%, declining to 2.9% in 2022, 2.6% in 2023, and stabilizing at a 5-year low of 2.5% in 2024. Total earnings before interest and taxes, EBIT, fell from $2.467 billion in 2023 to $2.267 billion in 2024. The net profit margin remains historically thin and volatile, plummeting sharply to 0.83% in 2024 from 1.95% in 2023. This substantial drop reflects the intensive investment cycle and potentially higher non-recurring charges or increased financial burdens associated with the strategic restructuring and acquisitions. Segmental profitability and drivers. Analysis of segmental performance indicates crucial points of strength and stabilization. The core French market showed solid ROI growth, reaching €1,042 million in 2024 compared to $988 million in 2023. More importantly, the ROI margin in France increased by 5 basis points to 2.6%. In a year characterized by severe inflationary pressures and intense price competition, achieving margin expansion in the domestic market suggests that the group's cost savings program is structurally effective enough to establish a profitability floor even while absorbing M&A costs and funding necessary price investments. Latin America provided necessary support, with ROI growing strongly by 26% excluding currency effects. This performance was underpinned by the operational efficiency and resilience of the Atacadão cash and carry format in Brazil, a model less exposed to the volatile, shrinking margins seen in hypermarket retail. V. Balance sheet, cash flow, and capital structure. A. Cash flow generation and liquidity. The ability to generate cash flow in a low-margin, high-investment environment is paramount for Carrefour's financial health. Net free cash flow, NFCF, stood at €1,457 million in 2024, placing the group firmly on its strategic path toward the 2026 target of generating over €1.7 billion in NFCF. This strong conversion of earnings into cash flow is particularly important given the thin net margins, 0.83% in 2024. Management is actively optimizing its balance sheet through asset management, including the execution of a sale and leaseback transaction of 15 stores in Brazil for €125 million in 2024, demonstrating efforts to boost short-term liquidity. B. Leverage and financial discipline. The substantial capital expenditure commitments required by the 2026 plan have put upward pressure on the group's leverage metrics. The net debt/EBITDA ratio has increased, reaching 3.8x on a latest 12 months basis, June 2025.
The fiscal year 2024 ratio was 3.2x, marking an 8.3% increase year over year. This elevated debt profile underscores the financial scrutiny applied to the transformation. The market must be assured that the high annual capex of €2.0 billion will translate into sustained EBITDA and ROI growth, justifying the increased leverage and supporting debt coverage metrics. C. Capital allocation and shareholder returns. Despite the increasing capital intensity and elevated leverage, Carrefour's management has signaled strong confidence in sustained cash generation. This confidence is materialized by a 6% increase in the ordinary dividend, raising it to €0.92 per share, supplemented by a special dividend of €150 million. This strategic move is intended to stabilize shareholder sentiment and potentially reduce the volatility premium assigned by the market, provided that operational stability, such as the initial ROI growth seen in France, continues. Furthermore, the launch of an offer to acquire the outstanding minority shares in Carrefour Brazil illustrates a strategic focus on consolidation and simplification of the asset portfolio, aiming to maximize returns from core efficient growth engines like the Brazilian operations. V. Valuation and peer comparison. A. Current valuation metrics. As of October 2025, Carrefour's latest 12 months enterprise value to EBITDA, EV/EBITDA multiple was 7.3x. This valuation sits near the lower end of its historical 5-year range, 7.1x in 2020. The PE ratio is highly volatile due to the thin net margins, cited as 0.0 as of November 2025. B. European peer benchmarking. Carrefour trades at a quantifiable discount relative to major established European and transatlantic retail peers, reflecting the market's current assessment of its operational risk profile. Valuation discount and consensus. The approximately 13 to 18% discount in the EV/EBITDA multiple relative to Tesco and Ahold Delhaize is largely justified by Carrefour's lower and contracting EBIT margin profile, 2.5% in 2024 versus peers typically above 3%, and its elevated leverage. To close this 1.1x to 1.6x valuation gap, Carrefour must deliver demonstrable margin convergence. The pathway for a sustainable re-rating hinges entirely on validating the strategic success of the 2026 plan. Specifically, the market will require proof that the anticipated $600 million incremental digital ROI and the shift to a 40% private label mix are sufficient to arrest the long-term margin decline. If the group achieves its confirmed 2025 targets for slight growth in EBITDA and recurring operating income, 17, showing strong progress toward the 2026 goals, the valuation discount is expected to compress, potentially delivering significant alpha relative to passive investment strategies. Analyst consensus targets currently suggest limited upside, with an average 12-month price target of 2.85, 23. V. Investment risks and mitigation. A. Execution risk and strategic transformation. The primary risk remains the successful execution of the complex and capital-intensive Carrefour 26 strategy. Failure to deploy the $3 billion digital investment effectively, or the inability to swiftly integrate acquired operations such as Cora/Match, could lead to cost overruns and customer attrition. Mitigation. Management has mitigated immediate integration risk by prioritizing speed, completing the brand conversion of Cora stores to the Carrefour banner in Q4 2024, securing early market share gains. The reliance on established partners in IT and consulting, such as Publicis Sapient and Centric Software, suggests an attempt to reduce internal technology execution bottlenecks. B. Competitive and structural margin erosion. The most significant structural threat is the ongoing competitive pressure from hard discounters, forcing Carrefour into sustained pricing wars that prevent margin recovery. Mitigation. The group's accelerated push to reach 40% private label penetration provides the core structural defense, allowing Carrefour to remain price competitive without fully sacrificing internal gross margins. This is further strengthened by the integration of RTG International into the Concordis buying alliance, enhancing global purchasing power for future negotiations. C. Financial and macroeconomic risks. The high annual capital expenditure of €2.0 billion, coupled with a net debt/EBITDA ratio peaking at 3.8x, creates financial rigidity. If recurring operating income targets are missed, liquidity could be constrained. Mitigation. Carrefour's active cash management focused on achieving the NFCF target of over 1.7 billion euros and strategic asset monetization, e.g. the 125 million sale and leaseback in Brazil, is crucial for maintaining financial flexibility. Furthermore, earnings volatility stemming from Latin America, particularly related to macroeconomic shifts such as the Argentinian inflation slowdown, is being managed through the consolidation of the Carrefour Brazil stake and reliance on the resilient cash and carry model.